For the past couple of years, tokenized finance has quietly moved from the world of speculation and trials to something much more real. Large banks, asset managers, and infrastructure providers have begun to adopt tokenized assets like never before. From JP Morgan to Franklin Templeton to Euroclear, the players behind this change are already using blockchain for real-world assets, RWAs, in production, not just testing. But here's the paradox. While retail narratives still tend to frame this debate in a which chain wins mindset, institutions are not thinking in terms of winners and losers. Instead, they're building an architecture, a multi-layer stack where Chainlink handles messaging, RWAs are the economic engine, and the XRP Ledger becomes a settlement environment. This is where confusion arises. On the surface, Chainlink and XRP appear to be competing technologies. But when you dig deeper, you'll realize they serve very different roles. This video will unpack that architecture, explain why these systems complement each other, and why institutional players need both to make tokenization work. So, instead of focusing on whether Link or XRP wins, we'll take a step back and ask the real question. What does institutional tokenization look like? And why do these two technologies serve complementary roles? Everything here is for educational and entertainment purposes only, not financial advice. Always do your own research before making any investment decisions. If clear, no hype crypto education helps you make sense of all this. Hit like and subscribe. It tells YouTube this series is worth showing to other newcomers, and it helps me keep building it for you. Let's begin with the catalyst for all of this: real-world assets, or RWAs. The financial world is overloaded with paper-based assets, ranging from money market funds and treasury bonds to short-term repo agreements and collateral pools. These assets are still largely siloed in legacy systems that introduce friction and delays at every turn. This is where tokenization becomes crucial. Tokenizing an asset means moving away from paper-based systems to a digital representation that can be tracked, transferred, and redeemed in real time. The shift to tokenization offers a faster, more secure, and more efficient way to manage assets. But here's the thing. RWAs aren't confined to one chain. A bank may issue tokenized funds on a private chain, while a market infrastructure might use a different chain altogether. This creates a multi-ledger world where coordination is key. That's why RWAs are pushing institutions toward a multi-layered solution. The need to coordinate across chains is why Chainlink and the XRP Ledger emerge as critical technologies. One manages instructions, messaging, and the other handles settlement. Both are necessary for RWAs to function at scale. To understand why Chainlink and the XRP Ledger are becoming central to tokenization, we need to think about the real constraints institutions face. Banks, asset managers, and market infrastructure are dealing with regulation, risk, and operational efficiency. Their priorities are clear. They need systems that can satisfy regulatory requirements, reduce operational overhead, and increase speed without sacrificing security. From that perspective, tokenization needs three things. Digital asset representation. This is where tokens come in. Assets must be represented digitally with embedded compliance rules. For example, a tokenized treasury must include features like ownership restrictions, reporting, and transfer controls. Cross-chain coordination. The financial ecosystem doesn't live on a single chain, so institutions need a way to coordinate transactions across multiple ledgers and platforms. Regulated settlement. Once an asset is tokenized, it needs to settle in a secure and predictable environment. It's not enough for the asset to move digitally. It needs to settle with finality in an environment that meets regulatory standards. Chainlink and the XRP Ledger each solve one of these problems. Chainlink handles the messaging and coordination, while XRP Ledger focuses on regulated settlement. Chainlink's role in this system cannot be overstated. Originally known for bringing external data, like price feeds, into smart contracts, Chainlink's real value for institutional tokenization lies in its ability to move critical messages between systems, securely, verifiably, and across different platforms. Institutions need to send complex instructions across different ledgers. Redeem this token here. Move this collateral there. Update this fund position. These instructions need to be validated, signed, and sent across different chains without relying on a centralized third party. This is the core of Chainlink's offering. It acts as a neutral, verifiable messaging bus that moves instructions securely across different environments. Without a messaging layer like Chainlink, tokenized assets cannot function. The fragmented nature of today's financial systems requires a tool that can translate, verify, and securely deliver instructions across chains, and Chainlink is filling that role. This brings us to CCIP, Chainlink's Cross-Chain Interoperability Protocol. CCIP doesn't move value, it moves instructions. When a bank or institution needs to send a message from one system to another, CCIP acts as the protocol that ensures the message is securely and correctly routed across different networks. The problem CCIP solves is simple. Different chains don't speak the same language. A private bank ledger, a public blockchain, and a market infrastructure platform each have different messaging protocols. CCIP provides a standardized way to send messages between them. This is critical for tokenized assets. If an institution wants to issue tokenized funds on a private chain and settle those assets on a public blockchain, CCIP is the technology that ensures those transactions can be coordinated securely and efficiently. The key takeaway here is that messaging doesn't just need to be fast. It needs to be secure, auditable, and compliant. CCIP ensures all of those things. Where Chainlink handles the coordination, the XRP Ledger handles the settlement. The XRP Ledger's role in the system is to provide a secure, regulated environment where assets can be settled and finalized. The XRP Ledger's design prioritizes things that institutions care about: deterministic finality, predictable transaction fees, and operational uptime. The XRP Ledger isn't just a blockchain. It's a regulated settlement layer. With features like authorized trust lines, freeze controls, and the ability to encode compliance rules directly into tokenized assets via standards like XLS52 and XLS55, the XRP Ledger is uniquely positioned to handle institutional-grade digital assets. And because the XRP Ledger has native oracles, it doesn't rely on external systems for price data. This reduces complexity and potential points of failure, making it an ideal platform for settling tokenized RWAs. In short, the XRP Ledger provides the infrastructure to settle value in a way that meets regulatory standards while keeping the process fast, secure, and predictable. Now that we understand the roles of Chainlink and the XRP Ledger, it's time to see how they fit together. Imagine a tokenized treasury issued on a private chain. An investor subscribes to that fund and a redemption request is triggered. The redemption message might start as an ISO 20022 SWIFT message. That message is converted into a CCIP instruction, which is routed to the appropriate blockchain environments: the permissioned chain to update the token, and the XRP Ledger to settle the value. This is a multi-step process, but it's necessary to make tokenized RWAs function at scale. Chainlink's messaging infrastructure ensures the instructions are routed securely, while the XRP Ledger's settlement environment ensures the value moves safely and predictably. This layered approach makes the system more robust. Instead of relying on a single chain to do everything, each protocol specializes in one area: Chainlink for messaging, the XRP Ledger for settlement, and RWAs as the economic driver. One of the biggest misunderstandings about tokenization is that it's a one chain to rule them all situation. In reality, the most important innovations are happening behind the scenes, where different protocols are working together. Chainlink is not replacing SWIFT. The XRP Ledger is not replacing Ethereum or any other chain. Instead, they're providing complementary functions in the system. Chainlink acts as the secure messaging layer, the XRP Ledger acts as the settlement layer, and RWAs drive the economic activity. This understanding is critical for anyone looking to get a clear view of where tokenization is heading. Looking forward, tokenization will continue to evolve, but it will evolve in layers. There won't be a single protocol that dominates the landscape. Instead, different technologies will fulfill different roles in a multi-chain world. Chainlink, the XRP Ledger, and RWAs are all part of that future. They're not competing with each other. They're working together to build the architecture of institutional tokenization. Which part of the stack do you think will grow the fastest? Messaging, assets, or settlement? Thanks for watching, and I'll see you in the next deep dive. This channel is for educational and entertainment purposes only, and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.